Hi everyone, welcome to the weekly stock market update. Sorry I'm a couple of minutes late. I was just checking out the markets. We had some friends around. So I will share my screen with you. Let me know you can see and hear me clearly as well, because that's important. If you can't see and hear me, what's the point? You'll see US interest rates have been moved down a quarter point, and there was some indication that the chairman of the Fed might be slowing down interest rate cuts in the future. Before everybody panics, that's what the fall in the S&P looks like. There's an old rumor in the, well, not a rumor, there's a saying in the markets: buy the rumor, sell the fact. The rumor was they'd cut interest rates, so people were buying into that. Then it happens, they sell the market. Way too early to panic and say that's the end of that then. So like I said, let me know you can see and hear me. I can see that you can. We've got Barry, Teo, Ryan, Richard, Peter, and everyone else. Just let me know where you're from as well, and if this is your first webinar. There's also a private Q&A from Barbados. Mike from Barbados, phenomenal. So we've got New Zealand, California, Oroville, California, fantastic. And of course, Taunton, Scotland, and the rest. So grab a comfortable chair, a pen and paper, and one of these wire phone, because it's got a camera and you might want to take images of some of the slides that I'm going to show you as well. Okay. Oops. Now, you're on this webinar because you could be anything from a pensioner, 20-something, people who don't want to miss out, you're disappointed with your financial advisor, fed up with funds which don't grow, high fees, and you want to have some knowledge, if for no other reason, to be able to question your financial advisor or your employer's pension scheme manager, that why am I not performing as much as I should? And if you're happy with them, then great. At least you should be as educated and informed as they are, so that you're not being ripped off. Okay, so it's to educate you as well. I didn't realize, Jeff, it's full moon. That's bound to have something to do with the crazy market falls. The other part of this webinar is not just to tell you where I think things might be going, but it's also this. It's really pinned down well from this. UBS rich clients get Goldman PIMCO strategies with no extra fee. So I'm going to talk to you a bit about sort of trying to be a bit of a Robin Hood and tell you what the major banks are telling their wealthiest clients. When we look at their data and see what they're telling their wealthiest clients, it's really helpful for me to then be able to share that with you, because it gives us a bit of a tie break. You know, if there's a couple of stocks which all look great, it gives me a really good tie break to be able to say to you guys at the same time, oh, look, between the two, this company is good or not, and so on. Let me just move that sort of out of the way if I can. There we go, because I'm going to put something on screen in a second to share with you all. Now, this is what my son's junior ISA looked like a few years ago, okay? And I'm going to share with you not just where we are, but actually how we were, say, 4 years ago. Because people go, well, where does your approach work? So I pulled out some old slides. If you've been following me, you'll know these. Now, he was born in 2018. This is not 2018. These are 2020 slides. And from when he was born and what we held at that time, this is not a recommendation to buy this today. This is a historic old slide. This slide is old, but it's to show that, yeah, it's not just about the future, but how did it do, Alpesh? How has it performed? How's your son doing? At that time, you could only put 4K into a junior ISA. Now, of course, I think it's 3 times as much. So I'll go into some of that. And of course, in terms of how's it all working out for you, put another way is this. This is all the way. This is all the way from 20 odd years ago. My columns in the Financial Times. So the information I'm giving you is not just something baked up yesterday or somebody who's new to the markets, which is the worst possible thing. And there's a lot of that nonsense on social media. We're going back over 25 years, 200 columns in the Financial Times, and 18 books. Now, this is important because it's your pension. So you've got to make sure you at least have a credible source, and where's the data, where's the information coming from as well. Talking about going back to history, this is one I received earlier this year in 2024 about somebody who joined and started following me from 2021 and how 100K for them in their portfolio had become 397,000. So from 100,000 to basically 400,000 as well. That's important because we want to make sure there is longevity, there is a track record, not just track record. Stuart, thank you. I will message you separately, not an issue as well. Because you want to know, well, not just how things are today and what I think about the future, but actually how did the same approach work out previously? My approach is very much data-driven. It is not narrative and story-driven. It's not, well, today it's AI. No, we're looking at the data, and the data shows that certain companies, which might be in AI, are doing well or not, and so on. And similarly, we need to know, well, how did that same approach of looking at undervalued companies which are growing do a few years ago? How is 2025 looking? That's another thing I want to cover in this webinar as well. Well, some of the biggest, wealthiest banks are publicly stating what they think. Now, just so you know, for the conspiracy theorists amongst you, they don't publicly say one thing and tell their clients, oh no, it's the exact opposite at all. Okay, this is what they think. Now, they tend to be over optimistic. The academic research, and I'm a big one for the academic research. I used to lecture on this at Oxford University on the academic research in investing. So, and I've written about it in my books. The academic research shows, and I'll always come back to data and research, not narrative and stories, data and research, given my background, both as a hedge fund manager, both as a former visiting fellow in business at Oxford. So data and research are important to me, which makes me very different to anybody else you'll hear on social media on the topics of investing. The academic research shows that banks tend to be over optimistic on the upside, as you would expect. They've got a vested interest. So we've got to discount for that. However, if that's what they're telling their clients, then they're bidding up the price. A bit like estate agents. If you get somebody like, if those of you know Foxtons, they always bid up the price. When I was selling my, I was about 33 and I was selling my second ever home, and I used to live in St. John's Wood. And they said, oh, we can get you double what everybody else had said. It's that kind of over exuberance, and it sometimes becomes self-fulfilling. Okay, so we allow for that. The other thing I want to point out is there is going to come a time, and you'd be absolutely right to believe that the market is expensive, as I'll show you the data. There will come a time when we will not simply want to just hold stocks. Once in 7 years, like in 2022, it makes more sense to be holding cash, okay? And the reason for that is, this is the Dow companies. I did this analysis a while back, okay? This is how much they fell during the financial crisis in 2008, right? Look at those numbers. Now, this is really important. There was no diversification for you. You could not diversify by simply saying, oh, I'll just buy in a different sector. I know I've got Coca-Cola, I'll diversify by having Visa, right? This notion that your IFA and wealth manager, who is undoubtedly somebody who's passed an exam using multiple choice with a 60% pass rate, so pretty high likelihood of succeeding, the problem you will face fundamentally will be that when the markets fall, there is increased correlation to the downside. Because there's increased correlation to the downside, the only thing you can do is in cash. And once in 7 years, you have to do that. Part of my job, contrary to what people believe, is not just about, oh, what will do well, but it's actually knowing when in those 7 years to hold cash, like 2022. We said to clients, actually, we can't find something good in January's list. Let's wait till February. February, let's wait till March. March, let's wait till April, and so on. Your IFA will never, ever, ever do that. They will never tell you you should be out of the market because they don't earn fees. They have a fundamental conflict of interest. So they can't ever tell you, just hold cash. Okay? I can, because I don't have a conflict of interest with you. I'm not a stockbroker. I'm not a retail fund manager. Okay? So I'll just tell you what I think is best. Okay? Sorry, that's my wife. She likes making appearances in my webinars. I think it's my wife. Now, value growth income is the base on which we're going to pick things. What we're also going to do on these things is know when to protect the downside by being in cash, being in a separate asset entirely. That's one of the key reasons fund managers fail, because they will hold you to this. This is why once in 7 years you will get a Scottish Mortgage Investment Trust down 50%. It is why Fundsmith screw up and then they'll advertise the other years. In fact, they'll make it very difficult for you to find out the year. So the question you've got to ask your IFA, how did you do in 2022? How did you do in 2022? Ask them that, because it's phenomenal how poorly they did, because they would not have told you to go into cash. Okay, here's another issue. What we're trying to do. One of the things that we found very useful is how we communicate all this across to clients. It's one thing to say we have a database that we share. It's one thing to say they have access to me. One of the most important things that we want to get across to them also is, as well as the data, we cross-reference it with some of the biggest hedge funds. There's no point us being really clever, looking at undervalued companies which are high growth, producing dividends, lots of cash flow, all the things you'd expect would lead a stock price to go up. There's no point us sharing all that if the really big money doesn't see it as well and is pushing up prices. So we will cross-reference it with what's out there amongst the hedge fund industry to do a tiebreaker, what's coming out with what Goldman Sachs is saying buy to their clients to make sure, is this making us money, and so on. And the reason all of that is incredibly important is that if we don't do that, if we don't communicate that across to you, then to you, it might just be a bunch of numbers. Okay, if I just show you this and say, see that value growth up there, crash return on capital invested, 6 month momentum, we need all of these first 5 columns to be green. Okay, and none of these that I'm showing you, if I just take that, you'll just say, oh, it's just numbers. So we make sure, if I were to click that, you'll see our filtered list right now for clients. That's exclusive to clients. So we don't share that publicly, obviously. If I then said to you, well, also we then filter it more to tie break with what the biggest hedge funds are, and I'll share some of those details later, what the biggest hedge funds are saying, then that gives you and us a degree of reassurance that not only did we find a gem, but some of the biggest money out there also is starting to see this and can put the prices higher. Okay, the point being, no point being the cleverest person in the room. If everybody else doesn't see it, then you're screwed. A new thing that I've also started doing is speaking a bit more since Trump of Ripple. And I own Solana, Ripple, Bitcoin, Ethereum from a few years ago. Was expecting nothing from them. And then all of a sudden, Trump comes in, and my Ripple holding, which has been below zero for negative return for about 8 years, suddenly shoots up. Okay, and the idea with it was 10-year hold. Basically, we'll see what happens. Now, it might go back to zero again in 10 years. Who knows? But it was, as the person here wrote, was meant to be for fun. Okay, so we'll talk more about some of that as an aside. Okay, don't put your pension in crypto. Crypto is more, although Wisconsin State Pension Scheme has now bought in July $100 million worth of Bitcoin. So it is becoming more likely, but at the moment I can't legitimately say to people, hey, go put your pension in crypto. I'd be irresponsible. It's all right for a bit of fun. Okay, as well. The other thing I'm going to discuss is, because it has been a stellar year, is how do you deal with profits? Okay, not after a week, not after a month. So if you've got that 50% gain, as some of the clients have on individual stocks, what do we do? How do we exit and manage some of that as well? Okay, so I'm going to cover all of that. I'm going to cover all the things that I see and hear from networks, contacts, from the hedge fund industry, the academics, from think tanks, from my political contacts, all the stuff that I'm hearing and insights and so on. And I'll share that with you. But fundamentally, just so you know, everything I'm going to tell you comes down to, and if I'm on the BBC, if I'm on CNBC, anything that I'm doing when I'm talking about stocks, the way in which I determine what I'm going to talk about, the way in which over the last 20 odd years with my Bloomberg TV show and everything else determined, to show you this, has been determined based upon that spreadsheet. So if I'm on the BBC talking about a stock here, we were talking about oil as it so happens, and companies around that. Everything that I will do is very easy. My job became very easy because I just base it on pulling up the spreadsheet and looking at the companies on there. What meets which are undervalued, because we know undervalued companies, i.e. lots of profits compared to share price, or compared to lots of profits per share, basically. Growing companies, lots of sales. Sales and revenues means the same thing. Profits and earnings mean the same thing. Growing earnings, growing sales, growing cash flow. Okay, companies with high cash return on capital invested, that comes from Goldman Sachs Wealth Management, but we need that ticked because their R&D department found companies in the top quartile generate 30% per annum returns if they meet that. Not every company, not guaranteed every year, but on average over the long-term 30% per annum. So we knew that we wanted that number to be ticked green. Okay, we know momentum's important from the hedge fund industry. We know Sortino and Alpha, incredibly important. Your IFA won't even have heard of Sortino because they're just not that well informed. I know this because I know IFAs. Okay, it's my job to know that they don't know any of this stuff, and it's somewhat worrying that they don't know the basics. Because if you think about it, Sortino, by the way, just for those who don't know, it's reward versus risk. It measures the average reward a stock has been giving you over a period of time versus the volatility or the downside risk of missing that and how quickly you rebound. Well, if you think about it, that's all you actually do need to know, isn't it, for a stock? Not that the past guarantees the future, but it is a guide. The company is rather good at generating good high average returns and very rarely misses those returns. And if it does drop, it rebounds really quickly. Surely that's the kind of company you want in your portfolio. So we knew we had to tick that box. It's reverse engineering. It is cheating. That's what we like to do. But we can't just rely on that. We can't just rely on one factor alone. What we know about all decision making with investing is, or anything else in life, is if you take a lot of data, filter it down, so we do that work for you to save you doing it, filter it down and get the best 20, 40, 50, 60, then even if you're not guaranteed the future, because we don't have a time machine to look into the future, at least we've removed the stupid mistakes of getting highly volatile companies, getting poor returning companies, getting companies which aren't growing, which are overvalued too much, and so on. And by ranking that and knowing that actually this is the most important factor, and how did we get that algorithm on value and growth? Well, we looked at the research and academic work from Daniel Kahneman, Richard Thaler, Eugene Fehmer, Nobel Prize winners in economics. They weren't when we started looking at it. They weren't when I started writing about the EFT. They weren't when I started talking about them. But the reason it's important you know this is because otherwise you might think, oh, well, picking stocks is like throwing darts at a dartboard, and it is if you're a fund manager. So that's critically important. That's Goldman Sachs. This is the hedge fund industry, and that's Nobel Prize winning economists. And that's why I want these all to be green. And we'll talk about some of those in a moment. This is a portfolio, for instance, a client put together rather well. This is actually their spreadsheet. They broke it down by the stocks and how much of their portfolio was in individual stocks, how much in exchange traded funds, okay, how much in what I call performance stocks, and how much they just went for momentum, okay, and how much allocation and so on. That's quite good. We share this spreadsheet with clients so that they can then decide, okay, well, what was the last historic drop? What could be the potential risk? How quickly did it recover? So they can work out, well, actually, I'm happy with that. No, I'm not. I'll put less money in. I'll have more stocks, etc. That's how it's done. What's the likely reward? What's the likely downside on, say, £1 million? This was £1 million portfolio, and so on. One of the reasons why UK investors time and time again, I'm sorry to say, fail is, if you look at this, the FTSE 100. Okay, if you think about it, your average pension fund manager, IFA, who is ripping you off, your St. James's Place, who are useless and rubbish because they have so much capital to allocate that they have to create a UK-only fund or a European-only fund or an American one. Now, if you think about it, there's several reasons they're going to fail. One, they can only, because they've got so much capital, put it into the stocks from that country. That restricts whether they're going to get good companies at all. And I'm going to show you later how Nick Train, for instance, apologized. Oh, I'm really sorry. I only invested in UK companies because that's what I was told. And they haven't done that well. So I'm sorry, I didn't perform well. Well, that's no bloody good to me because my pension sunshine hasn't grown. This is the FTSE. We are marginally above, okay, marginally above where we were in 2000. That's 2000. We're at 7,000. We're now at 8,000. Okay, that's quarter of a century later. Why is that relevant? Because unfortunately, a lot of fund managers can't even beat the index. Now, there's a very easy way for me to beat the index. I'll track the S&P and I'll do 3 times leverage on it. Job done. Okay, you can go to bed now. Okay, very easy. The point is, if I don't want to use leverage, I can just pick some outliers, which I think will be outlying stocks. The reason fund manager, your pension fund isn't growing, it's in a way not the fault of the FTSE, it's the fault of the fund manager who's telling you some lies, who isn't telling you the truth. They won't tell you that when the market falls, they won't tell you that you should go into cash. They'll just drag you down because they can keep earning fees. In fact, that's the time they need the fees because they're going to get bloody sacked and they're going to have job cuts. Look at 500 staff St James's Place have got rid of because they can't get the bloody performance. Okay, but they still want the bloody fees, don't they? And so they'll drag it out. Instead of saying, as I would, we need to be in cash. How do we know we need to be in cash? Well, very simple for us. We just look at short and medium term prices. We don't try and be smart and say, oh, I can see the future. No, we just look at short and medium term prices. If they're falling from an elevated level, short and medium term average prices in not just the S&P, but all the major stocks that make it up, then we know, hey, guess what? Let's give it a month before we pick some stocks. Oh, still falling. Let's give it another month, another month, another month. And before you know it, the year's gone and we held cash. Not because we could see into the future, we couldn't. Not because we had a crystal ball, we didn't. Not because we were cleverer than anybody else, no, we're not. Not because we had a time machine, we don't. But simply because, on the whole, not guaranteed, if average short and medium term average prices are falling, that momentum across different assets, across different securities, that tends to confirm, wait a month. That's all I said, wait a month. I didn't say it's going to fall. People try and over predict. We're not over predicting. So you said to me what's going to happen over the next year. I'm not going to over predict. I'll say over 2 years what's going to happen in a second, but I don't want to say over 1 year. I'll say over 2 years, I'm very happy with what I expect to be a 33% return, and I'll show you why. But over 1 year, no, I'm not going to tell you. I don't know. Why should I over predict? Why should I over predict? Fairly buoyant, but who knows? It could be 2022 again, in which case I'll protect myself by knowing that if short and medium term prices fall through what I just showed you, I'll hold cash for that year. 1 year in 7 I have to. Like Warren Buffett, if markets fall, I'll be very happy, which is what he's famously said in the past. Okay, that tracking of your domestic market is why your IFA pension fund manager is failing. SIPs were created by the government. They weren't called SIPs when they were first created, about what, 30, 35 years ago? They were created so you could manage your own pension. And the pension fund industry at first weren't happy. Then they got happy because they thought, you know what, all that'll happen is people will just still give us money through their SIP, give it to the fund manager and the IFA. It's their poor performance not telling you when to get out. That's the problem. And their poor performance isn't because they're idiots. It's because their hands are tied that they can only buy from a certain select geography. And by the way, because they have so much capital, they can only buy certain big companies because otherwise they'd be ending up taking them over. So what they're really doing is just tracking the FTSE 100. And they can't even do that. And even if they did do it, great, thanks. After 25 years, you've given me bugger all in terms of a return anyway. Okay, thanks for the favor. I'm taking quite a bit of time to explain this before we move into stuff because I think it's really important. I think in the past I've sort of skimmed over it as well. Okay. Barry said US indices going down. They are at the moment because, as I said at the start of the webinar, interest rates have come down. So people are taking profits, taking a lot of profits. This is the poverty gap between US and UK pensions and pensioners. If you consider that UK pensioners, which is down here, okay, over the last, 10 years, this is over the last 10 years, have pretty much got 41% return. You might say, well, I'm really happy with that. That's great if you like being poor, if you don't like your money working for you, if you just are happy with mediocrity. That is phenomenal. Great. Well done, you. Congratulations. You got 41% in 10 years for all that hard work you did, all those late nights you put into the job, all the rest of it, all that blood, sweat, and tears, all that anxiety in the day job. Well done. You got 41%. If you did nothing other than just track an index, whether it's the S&P or NASDAQ, that was 417%. You got tenfold more money as an American than you did as a Brit. The funny thing is, a Brit can invest in American stocks with their SIPs and ISAs. I'm not saying you necessarily should. I do. I wrote it famously in my first column in the Financial Times in 1999. Now, if you are risk averse, then you should probably just hold cash, put it into a bank account. If you are risk averse and say to me, what about currency risk? And don't realize that 10x swamps any fees on currency and currency risk, then you should definitely, just out of ignorance, not go near anything, and probably actually you might find it difficult to log onto the webinar if you didn't understand the basics. But for the rest of us, yeah, I'm sorry, we want that, or even just this, and that's before you even try to do better than that. Let's just assume you don't even do better than an index. Okay, hey, got nothing to do with it. Nothing with, oh, Alpesh knows how to pick this, that, and all the rest of it. No, you do nothing better than index. That's the poverty gap, and that's going to get wider because the American companies are exponentially growing at a faster rate than the British ones. Again, I had a friend over today for dinner who used to work in number 10. I asked him, what's your view on what's going on in the UK? And he said, well, actually, I guess people are getting angry at low growth. And I was thinking, well, actually, I don't think that's what's coming to their mind. But it's interesting. He reminded me about the low growth part. I forgot about that part. That's going to be a problem. This means I want in on this still. And as I said in the first, I'll show you the column in a minute. The first column in the Financial Times 25 years ago, I'm selling my UK holdings and only buying US ones. Because if I've got a tailwind, I'm going to do better. It's not because I'm clever. It's because I had a tailwind. I was just in a better market for me. Okay, this is from Goldman Sachs Wealth Management, Goldman Sachs Asset Management, Goldman Sachs Wealth Management. Now, most people would say it's a bit conservative. I think I'm over here. I've got 90% in equities. You might put 10, 20% in exchange traded funds, which are lower volatility. Exchange traded funds are index trackers without active managers. So they tend to be a bit more honest and you can control in and out rather than a fund manager pretending to be clever. Fixed income bank accounts. Okay. Jeff said US falling. Interest rates. The central bank said that interest. Well, I'll tell you what I would say on Bloomberg TV. It's taking profits, Jeff, from the big profits that people have had. So that's what's going on. And just so you know, this is what it looks like, which is people have been sitting on this. So obviously they're going to take a little bit right now. Okay. But this is part of the problem why people get panicked, because they look at things and they say, well, wait a minute. You get panicked if you haven't got a strategy and if you don't have context. If you've got context and you see, well, actually, this happens periodically. What if it becomes worse, Alpesh? Well, that's fine. We've got a strategy if it becomes worse. If it becomes a daddy bear, which is this scenario, okay, then we know to hold cash. If it's just falling, but the momentum isn't particularly bad, then we just wait it out. Simple. Got a strategy, not stressed. I'm not stressed. The important factors are these. We need those boxes ticked, because then what happens is we know the companies are not based, we're not gambling on those. That's what we've got. We monitor them frequently. You can look at your portfolio on your phone with the broker once every fortnight. Why? Why fortnightly? Well, you can look at it every minute if you want, but if you're investing for 12 months and then redoing the exercise, but you're looking at every minute, you're going to panic and you're going to start trading. And again, the academic research shows if you look at your portfolio more frequently, you're more likely to trade, which means you're more likely to exit prematurely. And the best recoveries which happen after the deepest falls, you'll miss out on the recovery part and have exited on the fall. Okay, so then you miss sitting back, which is what Warren Buffett does, of course. Most of the time, he just ignores the daily news and the volatility. And when you've got a strategy and a plan, you don't need to worry about that because you've got context and you've got the strategy. We tend to hold for 12 months, then do the exercise again. So go through the stocks again. Okay. Have, say, 15 to 25 stocks. And if something drops, as a general rule, but there are exceptions based on the volatility of the stock, as a general rule, if it drops 25% from when we bought it. Now, let's say you've got 20 stocks in your portfolio and 4 of them drop 25%, even though you looked from the entry, even though you looked at the value, growth, income, Sortino, but one of them goes up 100%. which typically happens out of 20, when you've looked at value, growth, income, look at an Nvidia, look at a Tesla and all the rest of it, then what tends to happen is it pays for the other 4, if 4 drop that much, if it was that bad. Okay, if 3 and 1 goes up 75, or 2 dropped and 1 went up 50, and the other 15 have to give you a return. So it's not panic stations because you've got perspective. We use one strategy. That's the strategy. We might use tactics to narrow down which stocks by using tiebreakers, like which of our stocks on our filters also owned by hedge funds, also owned by banks, what's Goldman Sachs just buy rated, which is on our filters. Oh, that's a tactic. But the strategy is the stocks have to meet these criteria so that we've got some degree of security in what we've purchased. How well does it do? Well, I showed you my son's portfolio from 4 years ago, 5 years ago. Okay, and I'll show you some more in a second, and also what happened last year as well. Okay, this year's too easy, massive tailwind, but I'll explain that as well. On the whole, probably want 20 to 40 stocks. You want, say, a certain percentage in cash, depending on how risk averse you are. If you're very risk averse, you'll have more cash. If you're risk loving, you'll only have 10% cash. And then exchange traded funds, maybe 5 to 10, based on, again, how risk averse you are. And then similarly with exchange traded funds, and I guess I under advertise this. Let me just show you what we've got. Okay. With exchange traded funds, and again, we need all of this to be green: volatility, Sortino, alpha. And we go through, as you can see here, what's that? 8,600 to narrow down which ones are all green. And we do that, we filter that. Now, exchange traded funds tend to have less volatility. Look at this, lower volatility, but can have rather good returns. 14% in 6 months is not bad, but they can have low volatility. But we need all of this to be green. Okay, all the first 5 columns need to be green. Okay, as well. The reason, say, a Warren Buffett or me doesn't panic when we see 1 day's results or 5 seconds worth of moves is because the people who will tend to panic and say exit, and this is the S&P right now, that's where we are. Okay, the ones who will tend to panic will then get out down here and then miss this gain. Okay, so you can look at this, and they're trading, and that's fine if we want to trade, but this isn't a trading webinar. If you want to trade, go short the S&P 500 now for the next 10 minutes. Okay, there you go. There's your trade. You can leave now. Come back in 10 minutes and tell me how much money you just made. Right? Those kinds of drops will lead them to missteps. So a lot of the time, you're sitting on your hands and not doing anything. You're holding the position. You don't keep staring at it because it causes people to panic. We know this. We know this from the academic studies I've published in the various books, and I'll make sure you'll get a free copy of one of my books as well. Okay? As well. And what that then leads to with some of this profit taking that we're seeing right now, and what's interesting is, and here's the perverse thing, some of the best days in the market follow some of the worst. And that's what leads people to get wrong-footed. For us, I'll give you an example with 2022. Were we bothered that the market fell? Well, in a way here, when it fell, let me just show you, not that one, I want to show you this big fall, okay, in 2022. The fact that it fell 27%, were we bothered? Well, yeah, in a sense that I'd love it if it only ever went up and did nothing else. But were we bothered that it fell in that we had to hold cash as soon as it crossed this point? Okay, so from this point here, and we got burnt, what, 6% from the peak? 4%, sorry, from the peak. No, because you were sitting on these profits, which is one of the reasons why it fell to begin with. Because there were so many profits that people had already accumulated and they were taking. I'd often be asked on the Bloomberg show with Sally, she'd just say to me, Alpesh, market's falling too. Why is it? And people would look for all these esoteric reasons about, oh, well, interest rates and maybe war in the Middle East and oil, all of this. And I said, well, they're taking profits. You know, some are short term, some are booking those profits, others are longer term, and they're not. But it's the short term momentum which leads to some of those being taken. The good news is when you get a bit more perspective is, well, actually the S&P, not that it's guaranteed to, but if it has 20% years, usually the third year, usually, but not guaranteed, which is why I keep an eye on the markets every fortnight at the very least, tends to be positive as well. Okay, so there's a bit of history here. There's a bit of history for all of this behind it as well. Okay, I'm going to show you something else in a second as well. Now, you should be able to see. If you want to have a look at a free copy of the book, just go to alpeshpatel.com/links, and that'll give you some of the data and some of the history, and you can download a free copy of the book there. Let's now look at what the market looks like presently. Okay, what does it look like presently? It looks like this in terms of valuations. Okay, in terms of valuations, this is what we're looking at currently. You're paying $30 for every future dollar of every future dollar in profit of Microsoft, and that's expensive. Nvidia, you're paying 29, Apple, you're paying 30, Broadcom, you're paying 31. So you can see there's expense there. Okay, why would people own any of those stocks then if they're so expensive? If in buying a share of Microsoft you're having to pay $30 for every future dollar of profit, why would they not just buy the cheaper ones? Because valuation is not the only thing that makes prices move. Growth, expected growth, makes prices move. So yes, the market is expensive. It's been bloody expensive for 25 years. You know, these have been red for 25 years, Microsoft, Apple, and the rest of them. And energy have probably been green for 25 years. We can't just look at that factor alone. We do need to look at other things as well. Okay? And that part's important for people to understand. So let's look at what's coming up in earnings. Well, actually, the most important thing is not what's going to move the markets there, but was the interest rate statement. The head of Federal Reserve. Now, I did a broadcast on the BBC when Trump was president last time about how he's pressuring the head of the Fed to reduce interest rates, and he's going to do it again. He's going to try and pressure the independent central bank in the US to reduce interest rates. I don't think he'll need to pressure them to reduce interest rates because the Americans, unlike the Brits, are focused on growth. That's not a political statement. In Britain, we're traumatized by inflation and we focus on inflation. In America, they focus on growth. They would sacrifice a bit of inflation for growth. We would rather sacrifice growth for lower inflation. The Germans are an extreme example of us. They would definitely sacrifice growth for low inflation because they remember the Weimar Republic and extraordinary inflationary rates there. Okay? So where does that leave us? Where that leaves us in the UK, by the way, is that the US is going to be having more inflationary pressures due to tariffs, due to less government spending. Less government spending will mean deflationary effect. The benefit of that would be you need to inflate the economy, and that means you need lower interest rates. That fiscal tightening, less government spending, more taxes. Tariffs are taxes. Okay, they're VAT basically on goods. But it's a clever name, tariffs, because you can blame foreigners for it. If you can blame foreigners in politics, you're laughing. Okay, you will get elected. How do you add a tax and blame a foreigner? You call it a tariff, right? And that's a smart move to do. If you want to be elected and you want to raise taxes, you call it a tariff. The problem with tariffs is you need lower interest rates because you're tightening the economy. So whilst the Fed has said we're likely to ease off on further cuts, which shouldn't come as a surprise, the market's going to get over it after this initial shock. It knew this. It's taking profits, and it's booking these ridiculously large profits that it's had for quite a while as well. Not least because you look at even Bitcoin's down, okay, which also tells you that this is people taking ridiculous profit. I mean, it's a fictitious thing, and yet it's even that's falling, which is barely connected to the real economy. That is profit taking if Bitcoin's also falling with the rest of the markets in the short term. Now, people like Warren Buffett get very excited when the markets fall because what they will say to you is fantastic. I can now buy quality companies at a cheaper price. How can I how do I know I'm going to buy quality companies at a cheaper price? Well, because they're falling, so I'll buy them back. So he has famously said, I like falling prices because it's giving me more opportunities. I was talking to a client of mine earlier today, and this is, sorry, by the way, a reminder that we want to tick all those. This is how things have gone in the past week, not right up to date real time. And you can see there was already a lot of red. There's only a few things holding things up, which is where the money was being poured into anyway. Okay. And by the way, you can tell if you've taken on too much risk is if you get panicked by a fall, like what's happening, say, in the market on any particular day. It means you've taken up more risk than your risk appetite, and you should have had a smaller position size. And one way in which to do that is to have more equities or more cash or more lower volatility, not individual stocks, but maybe funds. That's how you tell. So periods like this are rather good because they also tell you, Richard says this 18/12. Yes, this is the 18th of December, and it is 9:15 in the United Kingdom. Richard, you're having trouble joining. Click refresh if you're having a problem joining and you can hear me. This is how the past year has gone, okay? And I'm going to say over the next 2 years, not over the next 10 minutes, not over the next 5 minutes, not over the next 5 seconds, over the next 2 years, we'll get something looking like this again. I'm not saying necessarily be Google going up 50% or Apple only 28. It'll be something along these lines, not necessarily NVIDIA 166. Now, why am I saying 2 years and not one? It's a hell of a lot easier to say 2 years than one. That's why. Why should I overpredict? I'm not trying to sell you a fund or a brokerage, okay? I'll say over 2 years. And if I get that same again over 2 years, I'm happy. We're talking investing after all. Why should I talk in periods of 5 minutes if we're talking about investing? Okay. By the way, just as a reminder for those who might be of a nervous disposition, see that here? That's the S&P. See that drop there, which is today. Okay. Let's have a look. What happened here? Look at that there, where everybody in April said, oh my God, heart attack, and then boom. Okay, let's have a look at it time and again. Look at those, 1 day, 2 day, 3 days, and then we start the big bull run. I'm not saying that's going to happen now. What I am saying is that in actual fact, we've seen this play out time and time before. We don't worry until we need to hold cash, which will be when this happens, that scenario, which may well happen. But more likely is we're going to get something like this. I would say if the falls continue in the near term, we'll get a 10% drop in the S&P. Fine. Great. Because after that, it releases the excess pressure and you can resume back into your journey again. Right? It doesn't mean it's the end of the world. The great thing about investing is you'll always meet a group of people who think any day the market's down, it's the end of the world. Any day it's up, euphoria, they're about to win the lottery. It's neither of those two extremes. Okay, we've got a strategy, which is if we need to hold cash, we'll hold cash. But actually, this is what we're expecting over 2 years, so we don't want to hold cash today. All right? So that's where we are with that. Now, where are we over on exchange traded funds over the past month? These, I've done a video on YouTube on crypto, so you can see that on YouTube. Okay, on there. We know we're expensive on the market. Nobody's ever denied it. There we are. Price to earnings. You're paying $33 for every dollar of profit in the S&P. The total market cap of that is 63 trillion. It's about 2.5 times the GDP of the United States. The US stock market is 2.5 times the GDP, the annual GDP of the United States. Total earnings, 1.9 trillion. That's profits those companies generate is just under $2 trillion. The companies generate in profits each year about 10% of the GDP of the United States, less than 10%. Okay, which isn't bad. If you think about the US stock market, there's just the listed companies, and the total revenue is just around roughly the US stock market, at the GDP. The total sales are roughly the GDP of the economy, a bit lower. Those are pretty robust numbers. Okay. Market caps have increased 28%, profits have gone up 11%, sales have gone up 5% on US companies as a whole. Yes, they're a bit expensive. We know that. You'd have to be blind not to know that. Okay, these are the valuations of the various sectors. These are the forecasted growth. Oh, look, there's growth. That's nice to know. That's reassuring. There's something called growth. We're not talking recession. Okay, so that's good. That's good. And we'll come to that later. Now, I don't tend to look at sectors, as you know. I look at or just growth. I don't look at sectors, I look at individual stocks. We'll come to individual stocks. These have been the top gainers over the past, 7 days and 1 year. That's not a recommendation. So you can see when people are sitting on these kind of profits, well, the slightest hiccup or burp in the market, and they're going to look at each other and go, are you selling first? Oh God, you've sold, he's sold. Right, I'm selling. Or I think he's going to sell. He's twitching. It's like a Mexican standoff. He's twitching. I think he's going to sell. I better sell before he does. And then somebody sells, the next person sells, and you don't necessarily get a crash. You get a bit of a move down and profit taking. Of course, there's bloody profit taking, but we keep calm through it. As I said, unless it's time to hold cash, and I've told you the circumstances in which that happens. When you've got a strategy, you can afford to be relaxed. This is the UK market, a bit cheaper than the US because the growth isn't as highly expected. Sadly for the UK, what your pension fund's in, sales are down, profits are significantly down, and market cap has gone up. That's perverse. Market cap's gone up, but sales and profits are down. Not very good news, is it? In fact, some sectors are incredibly overvalued. You're paying £80 for every, £80 for every pound in profits a consumer staples company makes. Forecasted growth, okay. Materials seem all right over there. Anyway, I don't look at individual sectors. I look at companies. So we'll come to companies in a second. These have been the top gainers. Well, yeah. So I guess there's less. I was at the London Stock Exchange for a meeting with their primary listing team last week. And, well, they're up a bit, I guess. And Rolls-Royce, everybody's favorite, that much. So you can imagine they'll get some profit taking, I suspect. Exchange-traded funds. This is performance year to date, performance over the past month. Now, the reason exchange-traded funds should not be overlooked is, first of all, they're not funds in the traditional sense of a fund manager charging you a lot of money. They tend to track whatever the index is that they're looking at or group of stocks they have. The interesting thing about exchange-traded funds, and you still need to filter them, don't just blindly go in because you like the sound of a name like artificial intelligence. The thing about an exchange-traded fund is there tends to be less downside volatility because they're a basket of stocks. Okay, so we'll return to those as well in due course. So this is year to date. NASDAQ up 30%, S&P 26, the Dow 15, UK markets. Well, I get 4.7% interest on my cash. So the UK markets would have beaten my cash by a little bit, which is what most people want. They're happy with that. If you're happy with 6%, that's up to you. I prefer being able to have a shot at those numbers, 30 and 25%. That's what I'm after. Now, whilst the sectors have done this, I'm not gambling on individual sectors. Why? Well, because it's like a horse race in January. Which sector is going to win? I don't care. I just need companies which are going to protect me from me feeling stupid. How do I avoid feeling stupid? Well, I make sure I've got undervalued companies with high growth and dividend yield. So even if there's noise in the market each day, okay, even if there's noise in the market on a daily basis, that doesn't bother me too much because I can see that I've got instead good quality companies. So I don't get perturbed that, oh no, why did I buy that company? And a good time to know if you've taken too much risk or you haven't done enough due diligence is a time when the market's falling. Because if you get panicked, it means you didn't look into value, growth, income, cash flow, Sortino, alpha. Because if you looked at all of those, why are you panicked? Secondly, you don't have a strategy on exit. Otherwise, why are you panicked? Thirdly, you probably put too much money into it, i.e. relied too much on hope, which meant you were gambling. If those three things apply, then you've got it wrong. Even if you're in the right company, you got it wrong. We look for value, growth, momentum, growth, ideally low volatility as well, because I don't like volatility, momentum and value, because even if we looked at only one of those factors, we might not get a return. But if we look at all of them, then we're more likely to pick a stock, which is a subset of a subset of a subset, which means the best of the best of the best. okay? Because these are the factors that impact how stocks move. So we want a subset. Why? Because we're not a fund manager managing billions. You're not a fund manager managing billions where you've got to spray and pray, which is what your IFA does, spray and pray. Similarly, if you look at this over the past 1 year, and year to date and year looks pretty much the same. That's it. Now, we're also well aware there are periods when the market falls. Look at that. 32% in your pension going up by a third if you just track the index, is made up of periods when it falls. That's one. Two is made up of periods when you go sideways. Okay, I have nothing to show for it. Long periods, that's two. Okay, there are many periods where you go sideways. Okay, periods when you had a gain and it all went away. Look at that. That's three. Okay, periods when you had a gain and it all went away. And periods when it just went up, four. So out of the four things the market can do, it's only 25% of the time it's just going up. The rest of the time, it's frustrating you. It's scaring you. Knowing that perspective, having perspective, and that's what I try and give clients, having that perspective is really helpful. But I'm equally not saying to clients, oh, you should always be invested. No, 1 in 7 years, we know we have to hold cash. 1 in 7 years, we know we have to hold cash. Okay, so that drop there, we know that we've got no guarantee that won't turn into this. If it does, we've seen it before, and we know if that happens, fine, we'll hold cash until things settle down, and then we'll have a wonderful rally and start making our 40%. Okay, but we won't be able to do a 40% on a year where the market falls. Is it going to fall? Don't know. Don't know. But over the next 2 years, I expect a 33% total return, because one of those years, I expect I'll be holding cash a lot, and the other year, I'll expect it'll be bouncing up like it did in 2023, 2024, 2021, 2020. Okay, this is the FTSE 350. How they've done over the last month, I'm not necessarily recommending these. I'm just showing what's happened over the past month. Let's look at the S&P. Now, the S&P, as I have said time and time again, is overbought. It is like it was over here, but it looks like there could be momentum which continues. Looks like there might not be momentum continue. Basically, if, and this is a measure of average prices, short and medium term average prices, if that continues going upwards, then any falls can be ignored. If it falls as it did in April, as it did last year, basically, August, September, October of last year, then we can still ignore it, what I call a mama bear. Only time we don't ignore it is this scenario, which, as I showed you, from the peak, it had dropped 4% by the time we had to, 4 to 6% by the time we had to hold cash. Okay? So most of the time, you're still doing nothing, even though it's falling. Now, if we were trading, yes, we might minute by minute go in and out, but we're not trading. We're not here to talk about trading. Okay, brokers love these falls because they know they're going to make a killing from people paying commission, going in and out, in and out, in and out. Now, all I'm saying is at the moment, this is still rising, so these falls I'm still ignoring. That's it. I'm not trading. If I was trading, I'd say, look, get the hell out. Let's short the market. Okay? Same with the NASDAQ. Yes, there's some profit taking. Even then, we had to do nothing. We didn't sell out of our NASDAQ because it was still, the short and medium term prices were still rising. Here, while short and medium term prices were falling, as you can see from that falling, we still had to do nothing because it wasn't that kind of a scenario. Simple. So now I don't need to worry. We'll cross-reference it with what the elite banks are telling their clients to buy. So we'll also cross-reference anything on our filtered list, anything that we're filtering, which is all green. Okay, wait a minute. Let me go all the way over here. Anything that's all green. So it's none of these, because I'm not going to reveal proprietary stuff. But you can see there's a lot of companies which do not make the cut. Why? Because there's a lot of companies which simply are not good enough to be in my pension, my son's junior ISA, or my wife's pension, because they don't make the cut. They're not green right across the board. None of these will make the cut. None of these. I can keep scrolling. None of these are good enough because they don't make the cut. Now, they can still rise. Look, that went up 65%. But I'm not going to speculate on a high volatility company which generally doesn't produce positive returns, which has negative cash flow, which is overvalued with low growth. I'm not going to do that. What we do is wait for the ones which are going to tick every single box because there's enough of them, and then we can put them in. None of these do not tick every single box. None of these. Okay, so don't think, oh, he's told us, look, We've got none of these. I'll say it again. Now that's important because we can then cross-reference the ones that do with any buy recommendations from Goldman Sachs Wealth Management, UBS, Morgan Stanley, JP Morgan Wealth Management, and see if there's any cross-references. And if there are, we'll then project forward. Okay, we'll project forward on a trend continuing. In this case, it was Citigroup on the 22nd of November and Wells Fargo and Morgan Stanley, which said with this company, buy, buy, buy. We'll project forward. If that projection gives us at least 40% and a sensible stop loss of at least, say, 25% from there, that's it. Then we know we've got a high enough reward backed up by value, growth, income, cash flow, Sortino, Citigroup, Wells Fargo, Morgan Stanley telling their wealthiest clients, okay, not any one of those things. It has to be all of those things. If you only go by one of those things, you're going to lose money. It has to be all of those things. Once we know they've done all of those, then we can say, right, that'll do. That'll do. Gives us enough reward. And if we're wrong and we don't make 62, but we only make 32 or 30 or 20, that's fine, because it'll probably be because there were some market headwinds that we didn't get the full whack. We will also then, and this is important for people to know, I'll just share this poll. Underperformance is the main reason. I'll ask you which is the main frustration with fund managers, your pension performance, IFAs. 78% of you said underperformance. 78% said underperformance. 5% said lack of transparency. 10% said not trustworthy. Well, what I always do with my clients is I give them the whole data set. That's transparency. I give them this. It's updated each month, and they get all of this data. Why do they get the data? So they've got the transparency on which our decisions are made, so they can see themselves. Okay? And they can then say, well, actually, Alpesh, I don't want to put that much money in this, or I want to put more in this, but less in that. That's critical. It's your money. Nobody cares about your money as much as you do. I don't, and neither does anybody else as much as you do. So it is critically important that you get the data and understand it. The other way we cross-reference this is, we'll look at this, okay, and all of these, and then we'll say, well, wait a minute. Are there any hedge funds which generate 40% per annum for at least the last 3 years? So 40, 40, 40. What do they hold? And is what they hold also in our filtered list? So it's tactical. Our filtered list is value, growth, income, cash flow, Sortino, alpha. But do they also hold, like this guy, who's generated 473% since 2016? Yeah, but more importantly, 53% per annum for the last 3 years. If he's generated 53% per annum over the last 3 years, what's in his portfolio today? And do we still like it? Or do we not? For instance, do we think it's too overbought? Do we think it doesn't go up enough months? Okay, so we'll be really stringent. Do we think it can project forward at the same rate of growth? If not, we still won't buy what they've got, even if it's on our filtered list. If we think the momentum's too high, so we filter and filter and filter some more. Okay. These were the top 10 S&P 500 stocks over the past month. That doesn't mean we go and rush in and buy them, okay, at all. We still have to check for value, growth, income, cash flow, Sortino. Sadly, it can be, nope, too overbought, too late, too overbought, i.e. too expensive, not enough growth, could be too volatile. You're only one of three things, and you've got to work out which one you are. You're either risk averse, risk neutral, or risk loving. If you're risk loving, volatility you don't mind. If you're risk neutral, you want to minimize that, probably have 20% exchange traded funds, 30% exchange traded funds, 10-20% in cash, and the rest in stocks divided amongst 40 stocks equally, let's say. Okay, that's risk neutral-ish. Risk loving would be 90% in stocks, 20 stocks equally divided. And risk averse would probably be about 30-40% in cash, 30-40% in exchange traded funds, and probably 10 exchange traded funds because they're lower volatility, and the rest in 40 stocks divided equally. You see, risk averse, risk neutral, risk loving. It's asset allocation first. Okay, asset allocation. How much goes into cash, how much into funds, how much into stocks. Then it's which stocks. Unless you want to gamble, in which case you say, I'll just buy Apple. Well, wait a minute. How do you know it's suitable for your risk appetite? And how much is suitable for your risk appetite? For some people, it'll be 2 times leverage exchange traded funds on Meta. So if Meta goes up 10%, I make 20%, then that's suited to my risk appetite. If Microsoft goes up 10%, I make 20%, that's suited to my risk appetite. If it drops 10%, I lose 20%, that's suited to my risk appetite. Might not be for yours. Similarly with, say, a Walmart. Okay. Now, does this approach of value, growth, income, cash flow, Sortino? Well, I ask people, I say, well, you tell me what you think we've missed. We're looking at the P&L, the balance sheet, the cash flow statement. We're looking at all of these factors. What do you think we've missed out of all of that? Okay. As well. And we have a stop loss. If it drops 25% from entry, you exit. So you can't lose 45%, Arun. If it drops 25% from entry, you exit. Now, the reason people will sometimes mess things up is they'll either ignore exit rules, because there have to be exit rules. Secondly, they'll get things which are more volatile than they should have got. If you get things which are more volatile than you should have got, that's pretty bad, because it doesn't suit your personality. You're looking to be greedy. You're looking to be thinking that you can gamble in the markets. You shouldn't do that. What you should do is say, wait a minute, what's the volatility? It's 36%, 44, 36. We don't like anything in pink, ideally. Okay. So how does that work? We'll get some which will go up phenomenally and make up for ones which don't go up as much, because we don't limit the gains. If you get 100% return, it makes up for 4, which have dropped 25%. The reason for the 25% exit rule is so that you don't have limitless losses. Well, 100% would be limitless. If you think that even a Meta can drop 77% as in 2022, that's why you have it. Greedy people will ignore that. If you ignore that, that's pretty bad, okay, because it means you're gambling. It means you're not being professionalized in it. We will look, as I said, what hedge funds own. Not because we're going to copy what they own. This is how it was back then, but because we'll compare that and cross-reference that. We'll cross-reference that, okay? We'll cross-reference that. Do I think today's falls will recover within a few weeks? Well, I don't forecast what's going to happen. What I say to people is, were these falls to drop, then if it's like this, we'll ignore it. If this is rising, we'll ignore it. If this is falling, we'll still ignore it unless it becomes like this. And I anticipate a 33% return over 2 years. That's what I'll say. That's all I'll say. Might as well ask me, what do you think is going to happen in the next 3 minutes? I don't know what's going to happen in the next 3 minutes. I don't know what's going to happen in the next 3 weeks. But what I do know is, for the investment side, that's my outlook over that period. We'll also look, this is old, so don't go and buy this today. Well, as I said, look at what the hedge funds have, how they've performed, and are any on our list. Even then, we're not guaranteed a positive return. Even then, even if we cross-reference it with the billionaires like Bill Ackman, Bill Gates, George Soros, Jim Simons, who passed away sadly this year, Warren Buffett, even if we look at what's in their portfolios and look at how much money they've got in individual holdings, this is old, so don't copy this. That's the same approach I mentioned 4 years ago, right? If it's on our filters and on theirs, then that can be a good tie break, but doesn't guarantee it. Look at the most widely held stock amongst, this is the S&P 500 and the most widely held, institutionally held stock. It is not Amazon. It is not Berkshire Hathaway. It's United Healthcare. Their CEO of a subsidiary gets shot. Donald Trump says, I don't like middlemen like United Healthcare. He didn't mention United Healthcare by name. And they take a hit. That is the reason why you can't just put all your money in one company, and you still want to make sure, well, wait a minute, is this normal for the company? Is this volatile normal? Is this volatility a turning point or normal? Well, this is normal volatility. This, by the time we got to here, no, this is a get out volatility, hold cash volatility there. This is normal. This is normal. This is normal. When people don't know how to have a strategy, they panic, and then they'll ask any random person, what do you think is going to happen? What do you think is going to happen? And what the honest person should say is, I don't know what's going to happen. What I do know is, if the average prices are rising, then I'm in. Even if they're falling, as long as they've not fallen from an oversold position, I'm still in. It's as simple as that. The return I'm going to get is dependent upon the broader market. I can't guarantee the return I'm going to get. If there's a tailwind, I will do incredibly well. I.e., if the market goes up 30% like the NASDAQ has this year and 55% last year, I'll do incredibly well. If like 2022, I have to hold cash, I have to hold cash. It's a very relaxed position I have. Okay. Leverage big on low risk. Now, this is for the higher risk people. This is from, again, 2020. Why am I showing the old stuff? Because when people ask, well, how's it gone? That's from 2020 when we showed it at the webinar then. I pulled up the old slides to say, yeah, okay, we'll have 3 times leverage S&P. We'll have 2 times on that. Now, I'll only use leverage because I'm risk loving. Other people should not use leverage because when they get a day like today and the market drops a little bit, they'll be throwing up. So on the whole, you shouldn't be using leverage. But I have a few clients who love leverage because they've got the capital, they understand the risk, and that's the kinds of returns that they want. Okay. Devaka can email you what's in the difference between those. Okay. We can also cross-reference by looking at funds, because funds carry a lot of money and weight. And for instance, the quality ETF happened, this is historic, okay, this isn't today, happened to have these. If any of these are on our value growth income, we can cross-reference it with a fund which manages, $500 billion bloody dollars or something and say, oh, look, this is actually one which is on our list and theirs as well. This isn't today, all right? So don't get carried away. And that, again, can narrow down, because if you think about it, even here, where we're going from 10, well, how many stocks are there? 10,000 equities, 10,000. The blue one's on the London Stock Exchange. NASDAQ is here. 10,000 equities. None of these meet my criteria, so don't get carried away. Even though we're looking at that, we still need to narrow it down. We still have to narrow it down. Okay, and that's critical. We can narrow it down by looking at, not just looking at what's all green, because that'll still give us 200. So we've got to narrow that down. So we might look at what the biggest banks. Now, this is from 2020. And the reason I want to show you this is A, to show it works, B, to show you why we hold for 12 months. Because if you were to look at what City Core is today, God knows what it is. But the reason we look for 12 months is this. Because after 12 months, you can't look at old data of 12 months ago from their accounts. Say Capri Holdings, this is from 2020. And that was a 250% return. Within that time frame, then we've never owned this since. In other words, like a fruit, it ripened, overachieved, and then we got the hell out. It's a bit like owning Peloton, or Zoom. It was great back in the day when you had it, then you get out. Or Disney, 73%. It's now, I think, gone back up after taking a dip earlier this year. But that's from 2020. Some you return to. Okay, we had it in 2020. We returned to it in 2024. Some you never returned to, haven't returned to Capri. Okay, so it's once and that's it. But it is 12 months. It's not 1 month. It's not 1 week. If you want to trade, that's fine. We do now do what I call intermediate term holdings for clients, where we tell them, what we think is happening over 3 to 6 months. This was Uber Technologies. Haven't had it since 2020 when it gave 85% return. Okay, or Viacom, haven't had it since. It is not buy and hold forever. And this is to make that point. This is from 2020. We didn't buy and hold forever. It was 12 months. And then haven't even ever returned to it again once the returns had been made. Okay, that's 41% return where we'd looked for that. Now look at that. That's in the news today. You're not going to get the same returns. One of the every time in the same stock, and that's why you can't hold it forever. And the assassination makes clear why you can't hold things just forever, and you never marry them. We will look to see, for instance, what good rated analysts have said about any stocks that we hold. And that'll give us a tie break. If somebody gets a lot of high recommendations and somebody else doesn't, we'll go for the one which is on our list and highly recommended. Or discount cash flow. If we can look at discount cash flow, and this is, again, going all the way back to 2020, where price was at 63p. We said £1.61 is better. The reason this is important is because this worked then, it continues working since then. That's rule number one. Rule number two is you hold for 12 months, not forever, because things go up, then they come down. Okay. We'll also narrow things down, which are on our Excel and which are filtered, and which ones we like. We'll narrow it down by what are the hedge funds think. This is, again, old. Don't buy AbbVie. Okay, it's not a recommendation today for AbbVie. This is from 2020. If it's on our list and the hedge funds have it, and these are all the hedge funds we look at, then that helps us narrow it down even further. Okay, we'll leverage on statistics. When we look at this, and I use Wolfram Alpha for this, wolframalpha.com, then if I find anything which has this, now this is important for you today. In one day, something can move down minus 15%, so people panic. Maybe over 5 days, they're down 16%, even if there's a low probability, so people panic. 20 days go by and they're panicked because they're down now 30%. They didn't think they could be. When you've got perspective and you've got data which shows actually over 250 days, it's highly unlikely you're going to be down so much, you tend not to panic and you ride it out. You ignore the noise. If you have a tendency to panic, this kind of data that we have becomes incredibly important. Having somebody to run it past becomes incredibly important. But it also suggests, even if you don't have the data or somebody to run it past, that you've probably invested too much in something. Okay, because that's another way of reducing that panic station. And statistically, these return histograms help us a lot. Like I said, they're on Wolfram Alpha for free. So what we'll do when we're narrowing stuff down is, and as I said, none of these stocks meet our criteria, but let's say for argument's sake, let me try and find something. Oracle Power PLC did, for argument's sake. This is too volatile for us anyway, and the value growth income doesn't even register. Plus, it's got negative alpha. It's not a good one to have. It's too volatile, basically, too risky. Okay, but let's say it wasn't. And let's say we looked at it and we said, actually, over a 250-day period, there's an increased probability of a positive return. Over a 100-day period, there is. Then that's important. As a factor, you want to know that because we want to make sure that we don't hold things which will panic us. And that's why we look at this and then use, as I said, the hedge fund data, what the big banks are saying is a tiebreaker. Why are we looking at belt and braces? Why are we looking always? Why am I always talking about downside protection? A, so I'm never taken by surprise. B, so I have a plan in case of falls, so I'm not wrong-footed. And I've written about this in the books, in the Financial Times columns as well, because the research shows that people who don't do that, who don't look at all the data, tend to panic more than the ones who have it. Okay, it's why Warren Buffett doesn't tend to panic, because he's got all the data and the information. You can do this with UK, US stocks. You monitor them frequently. Like I said, once every 2 weeks is probably well enough. And the reason for that is the more frequently you look at it, if you look at it every day, that's going to panic you. Of course, if you looked at it once every 12 months, we have some clients who only look at it once every 12 months, then you're relaxed and you never realize you went through a roller coaster. But one way to avoid roller coasters is just to make sure that on the volatility, you have low volatility stocks with shallow drawdowns. Okay, avoid all of these. This is from a newspaper. I can't remember which newspaper it's from. Oh, actually, it's from Best Invest as well, the website. Okay, and it just shows you the relative performance to their benchmarks and how poorly they're performing. So I would say avoid all of these issuers of funds because they all make the same mistake. They have the conflict of interest with you in that they'll never tell you to go into cash and they'll never hand your money back and say, listen, don't be in the market at the moment. They'll always say, oh, there's a wonderful reason to be in Asia. Oh, you have to diversify and have global quality and Japanese and all the rest. Well, actually, when the markets fall, everything falls. Okay, so there's no point. There's no such diversification when the markets fall because there's concentration of risk. Everything's falling. Look at today. Okay, and when the markets are rising, you don't want diversification because that implies you want some things to be falling, which obviously you don't. You want concentration. So that's bullshit and they're lying. But also because what they do is they've just literally said here, we're only going to buy Asian companies or global environment companies. Well, there's relatively few of those. No wonder they're underperforming their benchmarks, let alone just absolute returns. Or we're only going to do emerging markets. or they do European. So they end up, because they've got so much capital, then fourthly, spraying and praying. So underperformance again. For me, this is useful. That's bank interest. It'll take 14 years, just under bank interest. Sorry, just over bank interest, 5%. It'll take 14 years to double money. I want to get up here as much as possible. That won't happen every year because the stock market doesn't do. Years like 2022, I got 0% because I was holding cash. Well, obviously, whatever bank interest paid me and a few energy stocks in July of that year, but call it zero. Okay, just ignore all of that. There'll be some years like this last year where the market had a massive tailwind, not me. The market had a tailwind. If I was really clever, I would have invented Meta and Nvidia and Tesla. I didn't invent any of those. Okay, I'm not really clever. I just ride the coattails of clever people. That's it. Whether it's the academic research they provide or the companies they create. That's all I do. Stand on their shoulders. Okay. So if I can get closer to that, it moves me down here. I want to move down here as much as possible. What does the future hold? I don't know. I don't have a time machine. I don't know what the future holds. I can tell you reasonably, as I might if we were speaking on a news interview on the BBC, I can tell you intelligently, well, I think this will happen or this, but I'm not going to do that because that's irrelevant, what I think. There isn't a column on the Excel spreadsheet about, well, what does Alpesh think? You're putting too much faith in me. You should put faith in the accounts of the companies in which you're going to invest. So look at their P&L, their balance sheet, their cash flow, their value, growth, income, cash return on capital invested, their momentum, Sortino, Alpha. There isn't a column which says, and what does Alpesh think? Because I don't think the market gives a damn what I think. So I don't have a column saying what I think. The computer has an opinion. Jim Simon's the most successful fund manager in history, the most successful hedge fund manager in history as well, who generated 40% per annum year on year after fees for so many years, said, we don't have an opinion on stocks, the computer does. And we follow the computer. And that's the same with me. So you shouldn't be, you can ask me if you want a conversation, what do I think? But you might as well ask me, what do I think about big clouds versus little clouds? Okay, why did I say 33% return over 2 years? I cheated. Statistics. Frequency of rolling 2-year S&P 500 return since 1950, average positive return 32%, 88.5% of the time. There you go. That's why. Hang on, Alpesh. You just set yourself up to succeed. No shit. Yeah, of course I did. I'm not going to try and big myself up and say, oh no, I can generate 1,000,000 trillion %. No, I'll just say 32 over 2 years because that's the statistical norm. Now, hopefully I can do better than that with all the data that I have and pick a few outliers and remove some of the laggards out of the S&P. Or I can cheat and just do 2 times leverage S&P and go sit on a beach for 2 years. Whatever it is, the point is, yeah, I cheated. I just tell you the statistics because I follow the data. How could I not tell you the statistics and then at the same time say to you, I follow the data? If I'm going to follow the data, I've got to follow the data, don't I? Okay, so I follow the data wherever it takes me. It makes life so much easier, people, when you've got the data in front of you. Okay, now, in 12 months, I've seen a 30% increase in my portfolio. Can I guarantee that? No. Can I guarantee that'll happen in 12 months? No. What I can say is if we continue getting a tailwind, we'll do well. If we don't, we might have to hold cash. I'll give you 2 extreme examples. Next year, one extreme example is we get another 30 to 55% rise in the NASDAQ as we did this year and the year before. 55%. Yes, last year, 30 this year. Okay, that's one extreme, right? The other extreme is we get a year like 2022 where the NASDAQ drops, the S&P drops, and we end up holding cash and getting 0%. So here's your volatility spectrum. You're going to get between 0% and 55%. Well, bloody hell, Alpesh, that's bloody useful. What's the average, Alpesh? Well, the average is 25. Divide the 2. Well, that's not bloody useful. That's like saying, I might be dead or I might be alive. What's the average? Oh, I'm half dead. Pretty useless. What is therefore useful is to remember we're investing, and let's take a 2-year outlook then. And I'll be happy if I get a 33% uplift in my pension over 2 years. Have a look at that if you want to see interviews with people, to see how they handled it on the Great Investments Program, alpeshpatel.com. They're video interviews with people, so they're quite good because they're interactive. It's very easy to open a SIP or ISA. You don't have to use Barclays. This is not an advert for them. I have no commercial relationship with them. I just picked a name that everybody's heard of. It could be Hargreaves Lansdown, Interactive Investor, Interactive Brokers, AJ Bell, Free Trade. Name me any brokers that you like, for instance. Somebody said they've lost sound. Let me know if sound's gone. It shouldn't do, because I've got very good headphones, I hope. The thing I want you to watch out for is please ask your IFA, how did they do in 2022? Under what circumstances would they tell you to hold cash? Which will be never. Okay, what they will tell you is this. Oh, we're well diversified globally. Then ask them, well, isn't it the case that when the markets fall, they fall everywhere? So diversification is useful. You actually have to be out of the asset class completely. Okay. Ask them if they know what a Sortino is. Ask them how they did in 2022. Ask your employer, which pension funds have you put me in and why did they in 2022 lose 20% of their value? This is Daily Mail. It's not me. This is Financial Times. Give workers power to ditch pension schemes. It's that bad. You might not know and have not got the memo. Okay. Okay, so please beware of that. I'm sorry I've gone on, but I just think this is really important, and I might do more webinars before Christmas as well, just because I think this is really important that I share all of this, and I'm going to do Q&A actually as well. Pensions, why do those retiring face massive losses despite FTSE highs? Look into this. It's because they invested in bonds, and they told you the lie that bonds are safe. Well, they are if you've got yield to maturity. But if you're not yield to maturity and you're trading and buying and selling bonds, which a lot of bond funds do, guess what? The prices go up and down. Ask Liz Truss. She made it happen. By the way, in case you don't know, after she made that mess up, and then the new chancellor, after Kwasi Kwarteng, the new chancellor was installed, one of the first things he did is he appointed one of my friends, not one of his friends, one of my friends onto the advisory committee for the Treasury. And that friend was a chap called Sushil Vadvani, who runs a hedge fund called Vadvani Asset Management, or he used to, I think he's got out of the hedge fund business. He used to be on the Bank of England. Why did they get a hedge fund manager to be advising Her Majesty's Treasury? Because they realized that it's not politicians who rule the bloody world. The people with the money, and it's the bond market. If your pension's gone up, your mortgage has gone up, you know why. So I messaged Sushil and I said, bloody hell, I wish the government had used their nous beforehand. Bit late now. Liz Truss doesn't know economics. There were a lot of people at Oxford who got the PPE degree who were dimwits. Okay. I met some of them. Hedge fund managers know economics because their life and reputation depends upon it. Have British fund managers become pointless expense? That's the Telegraph. Worst fund managers take $500 million in fees. That's the Telegraph. Okay. And that's the Guardian. So left and right wing are telling you, you might have missed the memo that they're screwing your pension. This was 2023. This is a year ago to the day. Okay. Been on the course for a year, finding it most interesting. Engineering, pension provided by Legal and General. The information was shocking, 20% growth between 2012 and 2022. As you can imagine, we're taking steps to remove and take control. Return of 20% this year already. Okay, been following your weekly reports, return 20% already. I didn't generate that. I put them in a position to know from the data that if the markets have a tailwind, then they got the return. Whatever they invested in got those returns. Yes, I showed them how by giving the data, but I didn't create those companies. I didn't create a market tailwind. And if there's a headwind, my job is very simple. If there's a headwind, as there was in 2022, is to get out and say hold cash. Okay, so it's either that or during these periods to say don't do anything. I only have a very simple job. Okay, three things I have to do. First of all, what ticks all the boxes? Well, bloody hell, Alpesh, even a monkey with a wrench could do that. Yeah, which are all green? That's rule number one. And even that doesn't guarantee things will go up. If there's a tailwind, they'll go up. 2, when the markets fall, should we worry? No, if this is rising or if it's falling but not falling like this. And 3, if it falls below this, sell. So now you know, buy, hold, sell. Buy, ticks all the boxes. Hold most of the time. Sell, then. That's it. Or if it drops 25% from entry. That's it. Okay, why is there a sell? Why don't you just hold forever? Well, because what's the bloody point of riding all this way up and then all the way down? Not only that, let's look at something, and this is something people never do, which they really should do. Let's look at Meta. Year after year, it goes up and up and up. We said in January 2022, we're going to wait till February. February, we said March. March, we said we're going to hold cash, basically. And the reason is that position, short and medium-term prices were falling significantly and sharply, not just in Meta, but right across the board. Now, here's the interesting thing that people don't realize. I didn't know, and this is nuance, I didn't know it was going to drop 69%. When we got back in, when the short and medium term prices were rising in January of 2023, I didn't know it was going to go up 181%. Over those 2 years, your IFA gave you a bloody heart attack, lost half your pension, and then brought you back to 0%, whereas we, stayed in cash in the first year, and in the second year made 150 odd percent or whatever it was. So over 2 years, we got 50% in that. We didn't know it was going to go up 150. If I did, I would put everything in that and nothing else. Okay. They got you 0. So that part of my job, which only happens once every 7 years, it's like wearing the seatbelt. You put it on all your whole life, and God willing, you never need the seatbelt. But I'm still there putting it on for you every single week. That part of my job happens once every 7 years. That's all. But it's bloody important, and this is why. That's why I exist. People think I exist to tell you, oh, get Meta because it's going up. Well, any bloody idiot can tell you that. All right? No. What they can't tell you is this bit. We have a very simple approach to it. That's it. It's a lot simpler than people think. Okay? This person got that pathetic growth over 10 years with their pension fund. All right? If they did the NASDAQ, just the index, not me, just the index, they would have gone up from 100K to 482,000. They did the S&P, they would have gone from 100K to 266. Not me, just the index. Instead, they ended up with 20%, even less than the UK index. So it's not me. You don't need me. Go and just look at the data. Okay? That's from previously. Netflix, I don't own. I've been covering to show you there are things I don't own which can do well, because I can't buy everything. So we've been covering this from there, as you will know. And did I know it was going to go up this much? No, I didn't know it was going to go that much. What I knew was it hit our value, growth, income, cash flow, and the momentum was rising, so it was fine. They're not all NVIDIAs. Walmart, I don't own. It's an 8, but it's overbought. Can it continue going up? Well, I don't like buying things in a falling market. Today it's fallen, so I don't like buying things when things are falling. So that's where we are with that. I'm on LinkedIn. You can follow me. I don't connect with people I don't know, but you can follow and see all my articles on there. There you go. Governor of the Bank of England. I was hosting him and a group of others at an event in India. He was in India. You know, he goes for a run in the morning, freaking 8 a.m. in Mumbai. The man goes for a run. His children, when he hadn't moved back to Canada, I think he moved back to Canada now. His children used to go to school with my best friends' kids. There's nothing to tell you. There's no interesting end to that story, by the way. Mark Carney, they really are as boring as they look, and they're meant to be. You really want a boring central banker, and he fits that bill. Wonderful guy, but fits that bill. So the point I'm making to you is, do look at those articles I've written. Nick Train apologizes for poor investment person. UK fund manager blames lack of exposure to tech and fossil fuel stocks and broader malaise in UK market. No shit. This is my point. Their hands are tied. It's not his fault. He's not actually stupid, Nick Train. The problem is his employer said you can only buy UK stocks. So no wonder he's underperformed, and that's your pension. Okay, that's your pension. Just going on trust. What's your thoughts on Reeves? I better not say anything, Theo. There's many reasons why I better not say anything. 50% loss on it. Well, let me tell you. Let me tell you what you already know. Okay, this government has made it very clear that working people are not people with assets, and they want to protect working people. Nothing wrong with that. Okay, if you are a socialist, which they are, they've said we want to protect working people. God bless them. I grew up in Leeds, in Armley. I think I've met quite a few working people, and it's bloody hard. It's a hell of a lot harder being a working person, i.e. no assets, living hand to mouth is what they're referring to, And just because you don't like the government, don't dislike working people, because, as I say, growing up in basically a mining community really is what a lot of it was, and hard labor community. I've got respect for people who work, because my dad was what you might call a working person. So we can all agree we working people, but I don't think giving assets to them via the route of the government, by taking them off people who have got assets and redistributing them to people who are working, is perhaps the best way to help them move up the social ladder. You know how people used to move up the social ladder? You know this. In the 70s and 80s, they'd work, be able to get a mortgage with their salary, a reasonable salary, a regular job, buy their own property, and the value of the property would go up because they could put a relatively low deposit, and that would allow them to work and be socially mobile. They could go to university without ending up in debt, and that would allow them to move into a higher paid profession. These doors are being closed. The mortgage and property route. So basically, and it's not this government alone, it's been a trend for a long time, which is for the fault of both governments. I mean, let's not forget, it was the Conservatives in '92 who put interest rates at 14% and busted a load of business people. I mean, you want to talk about economic mismanagement, tracking yourself to the German, because of ideology, German Deutschmark, because you wanted to try and keep interest. Do you know why they did it? It wasn't to enter the single currency. It was because they felt that if we copy the German currency, then it will make exports really expensive, because our exchange rate got strong. So exports become expensive. So employees won't be able to ask for higher pay rises, because they'll know that they can't get the exports because the exports are expensive in the companies. Do you really think the unions gave a shit that was the reason for the policy? No, they kept asking for the wage settlement. It wasn't the fault of the unions. It was the dumbass fault of Norman Lamont not knowing basic economics, and certainly not knowing psychology. His special advisor was a young David Cameron, who subsequently said, we should teach psychology more in economics, i.e. behavioral finance, which is the area I lecture on. Anyway, 50% loss on a name recognition Scottish Mortgage Investment Trust. There you go. So don't trust the fund managers and the experts. Please learn how to do it yourself. Please learn how to do it yourself. Incredibly important. 25 years of pension pain. That's me in 1999, where I've written, I'm selling my UK holdings and buying US ones. So this is not new. This is not Johnny come lately. This is a quarter of a century. That's when I had bloody hair, for God's sake. My first column in the Financial Times was 9/11, 1999. Okay. 2024, UK pension fund allocations to British stocks hit historic lows. And that's the way it's going. And it's the way it's going to go. Okay. Theo, my simple rule is, if you find any way in which the population, a mass part of the population, not just the rich, but the working class or middle class can make money, that door is going to get shut. Because in my experience, that's what happens time and time again. And at the moment, the tax-free breaks we get, whether it's our SIP or ISA, the rule I know is you better make as much money as you can, whether it's through your job or whether it's through your investments. I don't know what the exact percentage is. It better max it out, okay? Because it ain't going to be, do you think it's going to be a little bit bad and I just need to make an extra 5%? No, make as bloody much as you can and protect yourself, because the trend is always in one direction. They're going to make it bloody difficult, whatever color the government is. Quarter of pension gone in 1 year. That's blue whale. Now, these buggers, pension funds, they keep asking the government to give them more and more money. And the government and Labour are brilliant at this, because they understand economics even less than the Tories. So the pension funds are all over government saying, hey, allocate more money to us. And Labour are doing it. They're saying, right, we're going to mandate local authority funds, everybody else gives more money to private pension fund managers, because those guys get more funds. That's more pensions being buggered up, I'm afraid. Like I said, we will cross-reference against what the biggest and best brains are. I do not categorize myself as anywhere near the best brain in the world. Nowhere near, okay? I've met best brains in the world. I'm nowhere near any of them. So what I do is I copy what they do. So we will look at anything on our filters which meets what the biggest hedge funds are doing. Not because the hedge funds are doing it, but because if it's on our filter and they're also doing it and pushing money there, then they're probably amplifying what we've already selected. But that, as I've said, is what we look at. This was 2020, 2021. 2022 was 0% because we had to hold cash because the markets fell. 2023, look, the NASDAQ went up 55%. I'll show you what we did in a moment. You can look on the website. But this was 2020, 21 when we first launched the Great Investments Program, which was a sort of spin out of what we're already doing on the fund side of things. Now, I didn't know Crocs was going to go up 208%. I didn't know Generac was going to go up 137%. Because if I did, I would only have bought those. So again, that point of over prediction, I'm not over predicting. All we thought was these tick our boxes. If there's a tailwind, they should do well. If there's a headwind, they won't. That's it. People find that difficult to believe. They think after the event, I knew some secret inside information. Okay, I didn't. So can 40% happen? Yeah, it happens in years like 2021 and 2023, only if there's a tailwind. Look at the markets today. That's not a tailwind. If that happens every day for the rest of my life, we'll never make a positive return ever again. Okay, why did these names come up last year? How did we get 80%? Well, we didn't. They did. They did. Okay, we didn't. They ticked our boxes. We followed the boxes. Oh, Alpesh, did you know something about AI? You must be really clever. No, I knew bugger all. All I knew about Meta was I hate Facebook and their Meta goggles are shit. But guess what happened? It ticked all our boxes. So we don't rely on Alpesh's opinion. We rely, my wife told me Meta's for old people, and the goggles a friend of mine sent me, they're awful. I love him, but they're awful. And the metaverse, what a bad idea I thought that was. But I went with the data, and the data said, yeah, tick that box. Okay, Tesla. No, I wasn't back in start of last year, January 2023, thinking, yeah, this car's the way to go. It was just the numbers look good. And then within 12 months, we had to exit. Got back in after Trump. One of the reasons we look at this is from Goldman Sachs. Okay, it's from their quantum database, CROCI, cash return on capital invested. Total capital invested, post-tax cash flow. 30% per annum. Now, it's a slide which is a bit innocuous, and it's pretty innocuous at 10 past 10. Sorry I've gone on so long, but those who are on are the winners. They're the ones who want to know. Okay, and my work, well, BBC, hedge fund managers, American Express, Merrill Lynch, they commended it. This, by the way, you'll know how Broadcom's gone mental. That wasn't, we put our data into AI. And then we asked AI in 2023, ChatGPT specifically, and that's what came out. Okay, so we started doing this for fun. I'm still going to say it's for fun, a bit like my Bitcoin holdings. It's for fun. Okay, and guess what happened? And now it's gone up even more. But I'm going to put that AI as a fun category because we've not tested it enough academically. The reality is this: if AI happens to pick something which is also in this list, then we're very happy. Okay, if you've got 500,000 in a SIP or ISA and you make an extra 20% with my help and the data I give you and the information, then you've made 100K more than you would otherwise have done. It's as simple as that. Simple as that. Okay, this is what people we found wanted. When we tested what people actually wanted and what they were looking at, they wanted access to that database, monthly update on the Excel spreadsheet, and they wanted this. So everything else they weren't bothered about. It was these two things. Well, I guess this and this are the same thing, actually. Okay, those are the two things they wanted, and that was it. What I want to do is float this company. I was at the London Stock Exchange this past week. It was an interesting discussion on IPOs in tech. Having set up a hedge fund, I know that if we set up a company which is then floated, that can be $1 billion business. But like an Airbnb and an Uber, I don't want to own the properties. I don't want your assets. I want you to own your assets with whichever broker you choose. And so what we do is we take people on 10 at a time to give them all this data for life, not charge weekly fees, monthly, annual fees, nothing like that. Look at their risk profile, suggest goals for them, let them have the data and then suggest to us what holdings they think are right based on that data. We then check that against what they've said about their risk appetite, help them track that, show them how to do it, give them weekly updates so that they can get closer to the returns they want from the choices they've made. Make sure it's theirs for life. And also we do events, I do 4 events here in Parliament and in central London and met clients in New York and Singapore recently as well. Okay, the plan is we don't own your assets. We don't manage your assets. We give you the data for you to do it transparently, but handhold you. The way I've done it, originally I only wanted 250. We got past 250, blew the doors off, got great results. We thought, let's get up to 350. The first 350 would always have me as their mentor. The idea is after that, we expand more. We've got people in New York, and I put videos. We've got people in the United States, New Zealand, Australia, and so on. But that's my ambition. If you want to have a tour of it all in more detail, speak to Paresh. He was he was co-founder of a hedge fund, developed all the strategies for it. By the way, all the strategies he developed for it are in this book, just so you know, let you know. He co-authored that with me. All the strategies for that $4 billion hedge fund are in that book that he wrote with me. We work together. He's a great guy. I'd probably say one of my closest friends, actually, top 5 closest friends. He can give you a tour. Go to alpeshpatel.com/links. If you want to sign up, we're only letting 10 on at a time. But again, my ambition is to get venture capital funding. My wife works in venture capital, and eventually IPO it. To prove that concept, I'm going to take up to 350 in batches of 10. We're past the 250 mark now. And we meet together. We've just launched an online community for members as well, where they can speak to each other, which is great. Okay, as well. For webinars, there's a discount only for webinars. Outside webinar, there isn't, because during webinar, I only do webinars where I know I can take people on. Outside, time's more valuable. It is one-off. That's 24 hours. One-off, VAT included if applicable. Okay, you can go there as well. Ask me any questions. I know we've gone on too long. Sorry, Peter and everyone, it's gone on too long. Ask me anything about anything that you want, and I'm going to look at the S&P. What I'm also going to say, sorry, I've gone on way longer than I anticipated, but the reason is, I think if everyone's happy with it, then I'm happy with it. Where are we on the S&P? And feel free to ask me any questions that you think I've missed, because I'm happy to answer those as well. Yep, there we go. I'll move that for a second and look at that. Otherwise, I shall, while I give you a second to do that, and I'll look at the S&P in a second. You can also go to alpeshpatel.com/shares. You can also call and arrange if you wish, or email. What we found, people found the most useful, as I said, was this and the hand-holding calls with me. And people sometimes say, well, what happens if you're not around? Well, actually, all the education is in videos that I've done anyway online. So you've still got that, even if I were to fall under a bus. But also, it's a company. We have a data team who produces all this data, and we have a graphics team who puts it together. So the data and everything would continue, and the next in command, which would be Paresh, would take forward, and then he'd appoint a second in command were I to fall under a bus. So he'd be fine anyway, forever. These were the frequently asked questions. Who were asked, can you meet Alpesh? Hell yes. Long-term plan is to IPO it. How do you get time to mentor? Very easy. You realize that actually, once you've got everything set up efficiently, that people have the knowledge they need, and they don't need to keep taking driving lessons because you've taught them already how to drive. That's the advantage. Malaga. Oh God, sorry, Jeff, my friend. I hope to be out in Malaga soon. I think we might have a new client out of Malaga, actually. Now, any other questions? Oops, let me know at all, and I'd be happy to answer them. I think I had a private queue. Mike, from your chart, what is the definition of moving into cash, as I can't see what the lines indicate? Moving into cash, I do, and that's why I do a weekly update with clients, is that when that crossover happens from an overbought position, overbought is when it's at the top quarter of this graph, because what it's showing, so let me explain the maths in simple terms. It is showing the short and longer term average prices. And if both short and longer term average prices are falling, it suggests that both the short term traders and the medium term investors are both selling and getting out. Now, if that's happening after a prolonged rise, where people would also have the additional benefit of massive profits and therefore the incentive to take profits, and it's happening across other instruments, and this is the bit people miss, this subtlety. because the market's all about nuance. If it's happening across multiple markets at the same time, and there was a prolonged rise to begin with, so they've got the profit-taking incentive, because they look for all these other reasons to go, oh, is it to do with the Fed? Is it to do with the Middle East? No, it's to do with bloody taking profits. But that sounds stupid. So I used to always say on Bloomberg TV, when I had my show, I would say, well, no, they're taking profits. And people go, yeah, actually, that makes sense, doesn't it? But we don't sound clever when we say that. I've got a master's degree in economics from the world's #1 university, and I can tell you, it isn't to do with anything economics other than people like money, so they like taking some profits. Okay, that's it. It's really helpful to have a lot of knowledge to know you don't need any of that knowledge. As Warren Buffett famously said, if you've got an IQ above 110 in investment management, it's wasted. Anything above 110 is wasted. So I know I've got a bunch of IQ points, which are completely redundant. The advantage of that is you can actually speak in normal terms to normal, regular people, which is great because that's how you should with finance. And so if the short and medium term prices are falling, as I said, people are taking profits because they're sitting on a big gain, as you can see there, then that's the only point at which I want to be holding cash. Now, I can imagine you'd probably want to run this past me before you did it. That's why we said, well, if we're going to make this world class, our offering world class, we better make myself available. Barry, absolutely. I'll make sure we get in touch with you about joining straight after this. Apologies if we've missed any emails or anything, Barry, but I will make sure we do that straight after this. Well, I'll do it personally. Thank you, Glyn. Thank you very much. Merry Christmas, Glyn, and to everyone else. I'll try and do another webinar before Christmas. This is the best time for people to sort out their pensions because they've usually got a bit of time. They're also motivated because the new year's coming up. They're also incentivized because there's a lot of expenditure at Christmas. It reminds them that actually, wouldn't it be good to have lots of money as well? So I always find Christmas is the best time people find to sort out pensions. New Year resolution, bit of time, bit of expenditure. They're motivated. So I might do another webinar before that because I think people are also motivated to learn, which is when you want to do. Oh, by the way, I've got to show you something. Oh, how could I miss that? Look what's on my desk. So we had some friends over today, and their daughter is, I think, only 10. She caught sight of this and thought I was really cool because I've got the silver YouTube thingamajig. There's two types they give you. There's this one, and there's one which is more like a certificate. So I've got this one on my desk almost as a paperweight. Oh, there we go. It's really heavy as well. And she saw that. She thought, oh my God, that's cool. That's my education. I love it. I love doing that. Okay, so thank you very much on that. Any other questions, let me know. Otherwise, I've kept you guys way too long. I apologize for that. I'll try and maybe do a TikTok live or something where I'll do it a lot shorter and address things a lot quicker on that. But thank you all very much for now, for being up. For those who signed up, thank you. I'll give you a shout out. And thank you also for everybody who's stayed on for so long. Tejpal, Mittal, Nick, Terry, Victor, John, Ryan, Simon, thank you all. And I will be emailing those who've just signed up with the onboarding instructions and set up our first call actually as well. And we're going to be doing more in-person events because I found people find those really helpful. So I'll let you know those as well. And if there's anything else you want, anything I've missed, let me know. I will more than happily share anything, do anything with you, share my knowledge, share my know-how, anything that I can, more than happy to do that with you. Okay, so just let me know, anything at all. Thank you all very much. For now, I think that's it. Thank you.